Hey traders, Jason here from Leavitt Brothers. Welcome back from Thanksgiving break. Before getting started with this video, a quick announcement. We're doing a Cyber Week special. Buy an annual membership and we'll throw in an extra 3 months for free. Simply go to leavittbrothers.com, click on the subscribe button at the top of the page, and get started. All right, so on to the market. After a big plunge in October, the market has rolled up and down in a wide range recently. A big bounce was followed by an equally big leg down that erased the gains, and now the market is trying to move off its lows. There's no doubt the market has changed. Intraday ranges are bigger, volatility is higher, opening gaps are bigger and more prevalent. So in this video, I'm going to do an update of the breadth indicators. Have they improved? Do they suggest positive pressure is brewing? Are they positioned to support a full-blown rally attempt? Let's check them out. Let's see what's going on out there. All right, SP500 up top, 10-day of the 80 line in the middle, and then the cumulative 80 line down below. 80 line, it's old. It's been around for decades, but it still works really, really well. Okay, I've made the point here in videos and in reports that in order for an uptrend to be supported, you need the 10-day of the 80 line to do this. You need it to like roll up and down, mostly above zero. It can do, little penetrations below zero are fine. But the characteristic of an uptrend is that the 80 line rolls up and down above zero. So when you get bigger penetrations, that tells you there's something's going on. And if there's failure to regain the zero line, that's a warning. So right now, what we're looking for going forward is like, can the 80 line get up into this box here and can it stay there? Okay. It got up there on the early November bounce, but then it lost it. Okay. Now it's trying to move up again. Okay. So for me to believe that any type of rally could actually sustain itself, we need up and down movement in this box here. As far as the cumulative 80 line, pretty simple. Okay. Obviously it rode its 50-day up, took out its 50, came up, whoops, let me get rid of that. It lost its 50, rolled down, came back up, got rejected, and now moved down again. So if the market is going to sustain an uptrend, if like a bounce is going to morph into a full-blown rally, we're going to need the 80 line here to get above, maybe come down and test, and then actually stay above the 50. Okay, that's what we're looking for. Right now it's not happening. Okay, we don't have like a subtle beneath the surface hint that positive pressure is brewing, but that's what I'm going to be looking for. Okay, so the market's up today. It was up yesterday. It's fine. When the market's weak, it's pretty easy for it to bounce here and there. It's not anything to get excited about if you're bullish. But we need the 80 line to get above the 50 and stay there in order to sustain any type of move up. Okay, next chart, SP500 up top. NYSE new highs in the middle, new lows down below. Okay, I've made the point numerous times that in order to sustain an uptrend, we need new highs printing at a decent level. It hasn't happened most of this year. You can see going back to the end of last year in January of this year, we had new highs printing up here. But for all of this year, we've had new highs printing at this lower level. It's one of the reasons why I was warning people in September that we probably weren't going higher, and we had a negative divergence in place. You see the market going up here, but new highs were actually trending down. Okay, it's one of the reasons why in September I was warning people to keep stops really tight because the market was probably going to correct. Okay, now that we're moving up, what we want to see going forward is if indeed the market has legs, if it's going to sustain a move, if we're going to get some sort of Santa Claus rally, if we're going to go test the new highs, we're going to need, whoops, get rid of that. We're going to need new highs to print somewhere up here. Okay. It's not, I mean, it'll be hard, but that's what we're looking for. If new highs kind of come up here and then come back down and come up here, that's not going to work. Okay. It's not going to sustain a rally. Okay. We need new highs to get up here and sustain a decent level. And then the market could actually move up to its highs up here. Okay, but if this doesn't happen, then this over here is not going to happen. As far as new lows go, we got a big spike right here, which should be enough to produce a bottom right there. But as you can see, we had spikes. We had a spike here, we got a little move. A spike here only lasted a day, and then the spike here lasted 2 weeks and went for like 200 points. So the spike here tells us that near term, maybe the bottom's in place. So new lows act first. They tell us the bottom is maybe in place, and now they hand the baton off to new highs, and new highs need to expand in order to convince us, to prove that there's some good stuff going on. Okay, obviously it's not happening yet. This is what I'll be looking for. If we do get a bounce over the next week or two, I'll be looking to see if new highs expand. Okay, here's a different look at highs and lows. This is the high-low differential. Really great chart, really pretty smooth chart. Okay, right now the high-low differential trending down below its 50-day moving average. Okay, it looks a lot more like this from 2015 than here earlier this year. Okay, earlier this year it just kind of moved down, flattened out, and eventually recovered, and the market recovered too. Back in 2015, when this indicator moved below its 50 and trended down, and the space between the indicator and the 50 was growing and growing and growing, you can see through here what happened. The market went down. We did a little double dip here, and then even though we got a bounce here in the market back to its highs, this indicator couldn't even get back up to 50. All it did is kind of flatten out, move up a little bit, and then eventually got rejected, and so the market flattened out and it went down again. Okay, so when you're looking at the fact that this is like the gap here is growing, this looks more like 2015 than it does like earlier this year. Okay, so in order for us to sustain a bounce, we're going to need this indicator, the high-low differential, to get back above its 50 and start trending up. If it moves up to its 50, gets rejected, and then starts moving down, we're going to have, we're going to have a repeat of this. Okay, what happened here where it kind of moved down, got rejected, moved down, we're going to have a repeat of this. So even if we do get a bounce here, if this indicator doesn't go above its 50 and start trending up, we're going to have a double dip. And double dip could be, there could be like 4, 5, 6 months in between the dips. Okay, so just because we rally into December, January, February, if we don't get improvement from this indicator, markets are going to go right back down next spring. All right, so this is SP500 up top, percentage of S&P stocks above their 20-day moving average. I've made the point numerous times that in order for an uptrend to sustain itself, we need steady prints above 50%. The early November rally got us above 50%, but it couldn't hold. Okay, you notice here where steady uptrend holds mostly above 50%. Well, the fact that it dipped back down told us that the market's not ready to sustain a move up. Okay, so this is what we're looking for. Can this get up above 50%, and then can it just oscillate? It doesn't have to get really high. We don't have to have big spikes. We just need this indicator to kind of roll up and down above 50%, and that will support an uptrend. Even if it's a slow uptrend, it'll support an uptrend. So that's what I'm looking for right now. It's not there yet, but that's what I'm looking for. If we get a bounce here in the next week or so, can this indicator get above, and then can it stay there? That's what I'm going to. That's what we need to look for. Okay, next chart, similar to the last, except instead of using the 20-day moving average, we're using the 50. Okay, the line in the sand for this one tends to be about 55%. When the market can sustain prints above 55%, the market can steadily trend up. Okay, so you can see that here we get steady prints up here, and what happens? The market trends up. Okay, so obviously we lost it in October. We rallied all the way back to like 50%, and then we dropped. Okay, if you notice, if we compare this to what happened earlier this year, the indicator lost 50%, 55%, and then it rallied back, but then it got rejected here. In fact, it got rejected twice, and those rejections were right there and right there. Okay, and then it wasn't until it took a bigger bounce, a bigger plunge, moved back up, some resting period here for a while, for a couple weeks, and then we finally got above, got at a high level and could sustain it. So that's what I'm going to be looking for right now. If we get a move up to here, can we get above 50%, 55%, or are we going to get rejected and move back down? Okay, because if this thing moves up and the market moves up, but we don't get a higher print here, then the market's just going to get rejected by those highs and come right back down. Okay, so again, this is just what I'm looking for. It's not happening yet. I don't know if it's going to happen. I don't know if it's going to happen soon, but if we do get a December, January rally and we can't sustain prints up here, then the market's not going to go very far. All right, last chart, Nasdaq up top, Nasdaq bullish percent down below. I should mention that I'm only doing NYSE charts. I've only done NYSE charts with the SP500 because the Nasdaq ones look very similar. So let's look at this one. Actually, I got two more charts. So this is the bullish percent chart. As you can see, when the Nasdaq, this is, this goes back like 1, 2, 3, 4 years. So as we get a steady trend here, pretty much right through there, you get steady prints, above, right up here. Okay. The indicator could roll up and down. You get little divergences that appear from time to time, and they do lead to like little pullbacks. But as long as you get steady prints, basically in the low 50s or higher, the market tends to trend up. We got a big plunge, in October, and the November bounce completely failed to bring this indicator up. So I want to compare the current situation to back here in late 2015, where we got a double bounce here, rallied up, got rejected not once but twice, and then went right back south. Okay, so the market itself went down, put in a little double bottom, and then tried to rally up, and this is all-time highs here. Okay, but because the bullish percent couldn't get up here and sustain higher prints, the market simply traded flat and eventually just moved down. Okay, so that's what I'm going to be looking for here. When this eventually moves up, are we going to get rejected, or are we going to actually move up to here? Okay, that's what I'm going to be looking for. That's what you need to be looking for. The market could, the S&P could bounce 200-300 points here in the next 2 months, but unless we get improvement from breadth indicators such as this one, it's not going to go much higher. All right, one more chart. This is the one that's really really bothersome if you're a bull and you really want the market to move up. It is new highs at the NYSE on a weekly basis. You can see that it broke support here, moved down, and then right here, the market this is like all-time high territory. We're like close to 3,000, and yet new highs were just over here. They couldn't even, they were like way less than average, relative to the last couple of years. Moved sideways, moved down. It's one of the things I was warning about. So this is what, another thing that I'm checking out. If we get, over here we got double bottom, and then look how quickly it ramped up. Okay, look how much it improved. In fact, it improved over here, even though the market wasn't even, didn't even make a new high. It was still improving. So if the market kind of bounces right here, if this thing rolls up and actually keeps going, then hey, the market will probably be in good shape. But if we move up here and get rejected and roll over, you know what? The market's just going to roll over too. Okay, so let me get rid of. So a lot of indicators here. None of them are in great shape. I've kind of laid out what I'll be looking for. If the market rallies, December, January, February, if we have a Santa Claus rally, if the holidays are like a feel-good time of year, it's great. There'll be a lot of trades to be made to the long side, a lot of money to be made to the long side. But if these indicators don't improve, the market's just going to roll right back over. Okay? So thanks for listening. If you like the video, want me to do more, give it a like, share it with your trading friends. You can also subscribe to the channel right here at YouTube. Also remember, we're doing a Cyber Week special. Buy an annual subscription and we'll throw in an extra 3 months for free. Simply go to leavittbrothers.com, hit the subscribe button, and to get started. Again, thanks for listening, and I'll see you next time.